Global oil prices surge amid rising geopolitical tensions and supply cuts. Global oil prices have recently climbed to their highest levels in more than a year, sparking widespread economic concern. This sharp increase is largely driven by a combination of geopolitical instability in the Middle East and coordinated production cuts by some of the world's largest oil-producing countries, including members of the OPEC Plus alliance. The Middle East, a key region for global oil production and transportation, has seen escalating tensions, especially due to conflicts involving Iran and its proxies, as well as instability in Iraq and Syria. These developments have heightened fears of supply disruptions, particularly if major oil transit routes like the Strait of Hormuz become affected. Even the mere threat of such disruptions can rattle oil markets and push prices higher due to perceived risks. In addition to geopolitical factors, supply-side constraints have further intensified the situation. OPEC Plus, a group that includes the Organization of the Petroleum Exporting Countries along with allies like Russia, has continued its policy of limiting oil output to support prices. While this benefits producing countries by increasing revenues, it reduces global supply and contributes to price hikes. As a result of these combined pressures, Brent crude, the global benchmark for oil prices, has risen above $90 per barrel, a level not seen since late 2022. West Texas Intermediate (WTI), the U.S. benchmark, has also followed a similar trajectory. These price increases have broad implications for the global economy, particularly as the world continues to recover from inflationary pressures and economic instability caused by the COVID-19 pandemic and ongoing conflicts such as the war in Ukraine. Higher oil prices typically translate into increased costs for fuel, transportation, and manufacturing. In many countries, this could lead to higher inflation rates just as central banks have been working to bring inflation under control. Consumers may start feeling the effects at petrol stations, and industries reliant on transportation and logistics could also face tighter profit margins. There are also concerns about how this trend could affect monetary policy. If inflation rises again due to energy prices, central banks like the US Federal Reserve or the European Central Bank might delay interest rate cuts or even consider further hikes, which could slow economic growth. Some analysts believe the current oil price spike may be temporary, especially if geopolitical tensions ease or if demand weakens in major markets like China or the US. However, others argue that with limited new investments in fossil fuel